Hi, my name is Jordan Wilson. Today we're going to take a look at part 2 on asset correlations. In part 1, we covered what is diversification, what is asset correlation. We looked at a common sense type view of asset correlations using Starbucks as an example. Today we're going to finish off by looking at more of a finance investing example of correlations in action. We're going to start with a very simple investment portfolio. This portfolio has one asset. It's made up of 100% Exxon Mobil. And this is not accurate data, it just makes it simple to calculate, but we'll say it has a return, expected return of 15%, and its measure of risk, its standard deviation, is 10%. Now, the investor has heard about something called diversification and realizes that if they add a second asset with the Exxon, that will create this magical diversification effect. So the investor wants to invest half the portfolio in a separate asset, sell 50% of Exxon, invest it in something else. The investors found two potential assets, both offering slightly higher returns than the 15% from Exxon. Chevron has a return of 25% and a standard deviation of 20%. More return, but also a bit more risk. There's also a gold fund that interests the investor. It offers the same risk return profile as Chevron at 25% return, 20% standard deviation. So it would seem that you could probably add either Chevron or the gold fund and be in exactly the same position from a portfolio perspective. If we look at adding Chevron to the Exxon portfolio, we see that Chevron and Exxon are very similar assets. Both are multinational oil and gas companies, operate same industries, similar countries, oil prices, which is a non-systematic risk, will impact in a similar fashion. It's kind of like the two Starbucks that were kitty corner in Los Angeles. You'd expect that the two assets are probably quite highly correlated. And if we look, we see it's about 0.85, 0.87 is the actual correlation between Chevron and Exxon in Q1 2021. Now there's going to be some differences, like we discussed with the Starbucks. Different management may lead to different profitability. Better or worse baristas may add flow to their traffic, or they may drive customers away because they're slow. There's a variety of things that on a smaller level impact companies that are quite similar. If we look at Exxon, in 1989, faulty equipment, maybe human error, other factors caused a tanker crash, the Exxon Valdez in Alaska. And that had ramifications for a period thereafter. Chevron, over probably the last couple of decades, has been fighting the Ecuadorian government on environmental issues. So again, similar companies, but on a micro level, different risks that have impacted them. So if you combine the two companies, you do get some correlation and some risk reduction benefits from the diversification. But at 0.85, 0.87, they are quite similar. You're not going to see a huge reduction. Now, the asset correlation calculation, it doesn't impact portfolio return calculations. The portfolio return is simply the weighted average of all the assets in the portfolio. If you have 2 assets, 50-50. If you have 4 assets, each of them weighs 20, and they all are equally balanced, that would be 25% each. Or if you have 3 assets that are 10% each and one that's 70%, that's how you weight them. It's just a pure calculation. The asset correlation coefficient, the 0.85, does impact portfolio risk measures, the standard deviation. And here's where I kind of fall down the Investopedia trap as well, because we're not going to sit here, I don't think either of us would be happy if I started pulling out complex calculations and formulas and we went through the minutia. But on a general level, portfolio risk does take a weighted average of the individual components risk. Where it differs is there's a second part of the equation, and that asset correlation coefficient will reduce the risk unless it's 100% perfectly positively correlated. In this case, at 0.85, you're going to see some risk reduction. Not huge, because it's quite close to 1.0. And if we look at a 50-50 portfolio, we see that the return is just the weighted average, 20%. We have the expected return of Chevron at 25, the expected return of Exxon at 15, 25 and 15 is 40, divide by 2, 20%. However, the standard deviation, which has that second component to the equation, its standard deviation is 14.49%. And I note there that the weighted average risk would have been 15%. So you do get a slight benefit in your portfolio by adding a non-perfectly correlated asset, in this case, Chevron. Now let's look at the other investment option, the gold fund. Much different asset. Chevron and Exxon in many ways are the same company. And that gave us a 0.85 asset correlation, very similar. Much different between a gold fund, in this case just assessing the spot price of gold, versus a multinational oil and gas company. We would expect the correlation to be quite weak relative to Chevron. And if we actually compare Exxon with a specific gold fund, we see the correlation is pretty much 0. So there's no connection between the two. How gold does really has no connection with oil and gas. Here, if we take a 50-50 portfolio, we again have the same return at 20% because we had assumed 25% return in the gold fund. But we see the impact of having a weakly correlated asset. On the face, the gold fund and Chevron had identical standard deviations. When we combined Chevron with Exxon, we found the standard deviation 14.49. But here with the gold fund, it falls all the way to 11.2%. The weighted average is still 15, but that second half of the equation, the fact that we're pretty much at zero correlation, does a nice job of reducing our overall portfolio risk. So the notes I have here are high correlation assets can still reduce overall portfolio risk. Chevron, Exxon, 0.85, we saw a little bit of risk reduction for the portfolio. But the lower the correlation, the better. And we would have seen an even lower correlation, or a lower standard deviation, if the correlation had been, say, minus 0.4. The lower the correlation, the better the risk reduction. So we saw that Chevron and Gold Fund have the same risk, same return, but the Gold Fund is going to be more efficient at reducing overall risk. We go back to sort of that Investopedia statement. We want a mix of a wide variety of investments. What is wide variety? Now, some studies will come out and say 25 to 30 equities, and I believe that's what Investopedia has as their example. Other studies will show different amounts, some slightly less, some slightly more. In general, you'll often find fixed income, studies showing 10 to 15 bond combinations. But it's less about the number of equities that you have, more about the correlation between them. If I put together Exxon, Chevron, Shell, Total, and 10 other oil and gas companies, they'll have a high correlation between them. So your risk reduction, whilst it will improve for each asset you add, because they're not 100% correlated, you're not getting that same bang for the buck as if you're adding a gold fund with Exxon. So it's less about the number of equities or bonds, more about their correlation between each other. The other point is the diminishing returns. The greater the number of assets, yeah, the greater the benefit, but it's diminishing returns. If I have Exxon and I add the gold fund at 0.002, that's substantial risk reduction for my portfolio. If I have 999 equities in my portfolio and I add the gold fund at 0.002, say to everything, how much bang for the buck do I get if I'm only investing 1% of my assets in the gold fund? So that's an issue. Is, yeah, the more assets, the better. But unless you're adding huge percentages, you won't get that risk reduction benefit. And then the other aspect with the greater number of assets is the opportunity cost for your time. Do you want to monitor a portfolio with 1,000 different investments and constantly look at the correlations and adjust? That takes some fair bit of time to do, and there's a hard cost, transaction costs, maybe triggering capital gains when you rebalance. So you need to sort of look at the number and then be a little bit realistic as to what you're doing. Another aspect to what is right. Part of it depends on the investor, your skill level or interest. If I'm playing a game, I could probably create a well-diversified portfolio with under 10 assets. But what's the purpose in that? As well, the investor's objectives, personal constraints, the amount of wealth they have to invest. These are the sort of issues from your investor profile that dictate what is right. If I have $10 million, maybe I can go out and put in 100,000, which is decent size, into many individual investments. If I have $5,000, how many investments can I realistically purchase? And then as well, risk tolerance always comes into play. If I'm a widow and orphan, even though it's been explained to me that the gold fund provides excellent risk reduction benefits to my portfolio if I combine it with Exxon, maybe they will, maybe they won't, but probably not. That their risk appetite is such that they would invest in a gold fund or some other more exotic vehicle. So they might prefer less risk reduction to stay in solid blue chip stocks or AAA rated government bonds as opposed to asset classes that provide negative or very, very low asset correlations. Two of the questions that came up with the Investopedia definition were, does diversification provide higher returns in a portfolio? And or does diversification provide lower risk in a portfolio? As for higher returns, I would say no, with an asterisk, because I understand what Investopedia gets at. Your portfolio return is simply the weighted average return of all the individual assets. So you can't increase your performance simply by diversifying. However, I think what they mean here is that diversification does allow investors to add higher return assets to the portfolio. And we saw that with either Chevron or the gold fund. Both offered 25% expected returns versus Exxon's 15%. If we diversified and sold 50% of Exxon and invested that amount into either the gold fund or Chevron, we would expect to see a bump in the portfolio return on a weighted average basis. 25% plus 15%, 40 divided by 2, 20% in the portfolio now, as opposed to just the 15% when we only had Exxon. So yes, higher returns, but it's not the diversification that gives you the higher return, because asset correlations don't impact portfolio return calculations. It just allows you to take on higher risk assets which have higher returns. As for the lower risk, yes, we saw that. If assets are not perfectly correlated, adding them to the portfolio will reduce overall portfolio risk. That said, we did talk about the diminishing returns. For every additional asset that you bring into the portfolio, it's diluted against the great portfolio overall. And so depending on what the weight is of that asset, it may have more or less impact on risk reduction. The final point I'll make here is some investors become overly fixated on asset correlation. we're running around saying, oh, I've got this S&P 500 index fund. So I need to find negatively or low correlated assets to add. And if we look today, sort of again Q1 2021, we see that sort of that 1 to 10 year T-bill treasury bonds from the US government are about 0.3 to 0.4 negative against the S&P 500. If I add T-bills to my S&P portfolio, that provides excellent diversification. However, what's the yield? What's the return on those T-bills right now? You may be chasing negatively correlated assets to add to your portfolio, but you still have to factor in what's my expected return from that. So it's nice to reduce the portfolio risk, but you have to be cognizant of the return for the assets that you're bringing in, as well as the quality. Maybe you're more comfortable with Chevron as a company than you were of the spot price of gold. So you can't just get fixated on what the asset correlation is. You have to look and see how it fits into your portfolio and what your plans are. So don't just add poor return or high risk instruments simply for the correlation. I think that's a good coverage of asset correlations. I want to have one more session where I talk about some of the pitfalls of asset correlations. The big one is that the correlation is not static. It can change over time. It may be permanent, may be temporary. And again, that sort of falls into that don't get fixated on correlations because they may change. And we'll do that next time. Thanks for your time. Have yourself a good day.